Hi everyone, thank you so much for joining us at this next webinar. We're using Optuma. So today what we want to do is talk about the signal tester. Now, we've done a lot of explanation of signal tester and the way we use it and some of the research that we've done with it. But what I really wanted to do today was really get in the practical use of it. So really getting into, all right, let's think of an idea. Let's take that idea through to the signal tester. As we go, we're going to explain a lot of the theory, probably in a much more practical way than we've done in any of our more academic papers and discussions, etc. And then we want to sort of talk about how we can tune an idea, and also part of that whole process, we'll talk about why traditional backtesting has some really serious flaws in it, and to make sure that you're aware of those and you can watch out for those issues. So again, you know, if you've read all of our material on backtesting, I'm going to touch on the theory pretty quickly this time, so as not to bore you, but if this is the first time that you've been introduced to signal testing and signal testing in Optuma, I want to just lay a little bit of the foundation. You can find a lot more information at our blog. There's a lot of articles on signal testing at optuma.com/blog, and also some of our research papers. You can find those at optuma.com/research. And particularly in those research papers, you know, we're trying to be a lot more quantitative about the way that we do technical analysis, and so you'll be able to find that information there. Now, this is a really heavy, dense subject, and we're going to go through a lot. We're going to try and layer and build. I'm pretty sure that we're going to be splitting this over 2 sessions. So we'll see how far we get, and then we can always continue on with this one next week as well. So the first thing we want to do, you know, I've got a chart here in front of me. The first thing we want to do when we're doing quantitative analysis is that we want to start looking for ideas. Now, the idea that you use is really going to be dependent upon you know, the style of technical analyst that you are. You know, are you looking for a mean reversion? So using oscillators, saying, I want to find things that are oversold and I want to get that short-term gain on a mean reversion type basis. Or you're looking for the bigger trends. You know, am I going to use things like a moving average crossover and say, right, that's my signal. I want to capture the bigger trends and try and stay out of the noise of lots of trades, whipsaw trades and things like that. Or, you know, maybe you're looking at different types of momentum indicators or volatility indicators, as we talked about last week with Kirk Northington. So there's a lot of different ways that you can do this. But what I want to show you is the way that we can approach it with an idea and then start thinking about, well, how does that idea translate to a repeatable system that I can apply and have confidence in? Because the bottom line with technical analysis, you know, every time we take a signal, now, you know, we have a very wide variety of clients, you know, from portfolio managers who are, you know, managing hundreds of millions of dollars, where you don't have the luxury of just saying, oh, I'm going to jump out of Microsoft today, or no, tomorrow I'm back in it again. You know, you're looking more for scaling in slowly, holding a position for, you know, 9 to 18 months, etc. So the way you would set up a test in that environment is very different. But then we've got people all the way down to a private trader where you're trading your own money, and most likely you're answerable to your spouse. And so there's a lot of pressure on. So what you're looking for is very different. And the signal tester enables us to sort of look at both camps and be able to say, okay, well, let me set this up in a way that makes sense to me. And again, we'll show you that as we go. So let's just start looking here at an idea. We've got this chart here, and let's just say, for instance, I just want to use something fairly simple. I'm going to do I want to just do 2 moving averages. So let me just throw on a moving average, and I'm going to make this a 20 period. I might zoom in on the chart there. So we've got a 20 period moving average, and our second moving average, I'm going to put on, let's just make it, oh, I don't know, 100, just for the sake. So the first thing that I would do, whenever I've got an idea, whenever I observe something and I'm thinking, you know, this could be a really good strategy. First thing I want to do is just put it on a chart. I don't want to go to signal tester. It's not the first port of call. It's really looking at a chart, putting the tools on and starting to look at it. Our ability as technical analysts to process visual information is really, really powerful. And so, you know, we can see things that computers, it's just so hard to code up. And that's why I want to go back to charts. I want to look at the chart. I want to see, what do I see? Do I see something here which I think is worthwhile pursuing and looking into it to see if I can get some benefit and some lift in my strategy. So hang on, let me just change one of these line colors. So I'm going to go here, make this one red. All right, so we've got our fast moving average as red and our slow moving average. Now, a very typical way that we would approach that is to say, okay, when the fast crosses above the slow, we're in, and then, you know, you would exit, for instance, when the slow fast crosses beneath the slow. The thing that I've got to really stress about the signal tester is that it's not a back test. Now, again, where I came to this was I was doing some research work on relative rotation graphs, and we talked about those a couple of weeks ago in a webinar, and I was working on trying to find a quantitative system that we could apply. So taking relative positions or the calculations on a relative basis and then see what absolute gains we could get. As I was doing that, I created a system, had a back test, put $10,000 in the account, let it run, got a really nice result. And I thought, well, that's great. Okay, so let me now put $100,000 in. And I would expect very similar returns on a percentage basis. But then as I ran it, I got very different results. My results actually went down. And I'm just like, what on earth is going on here? Why is this happening? And as I dug into it, what I realized was, you know, as an example, there was a day where there were 6 signals. So there were 6 times in one day where I had a signal to take the RIG an equity based on that signal, on that calculation. And what had happened is that I only had enough capital when I started with 10,000 to take the first 3, and I missed out on the second 3. Now, when you extrapolate that out, that means that we're basing our test on only part of the information. So, you know, it's basically what we want to do in Optuma and what we want to do with signal testing is we want to consider everything. And then once we've considered all of the samples and we are able to distill all of that down, then we've got a far better idea of what we can expect in the future. The back testing just wasn't giving that to me. And that's what sent us on the hunt for creating something which was a lot more robust and a lot more inclusive in the way that it allowed us to sample all of the situations, or the signals, I should say. So what we've got here again, we've got this signal here. The first thing I need to do is sort of, as I said, observe it, say, yep, do I like that? And I've got to say, yeah, there's some really nice signals here. You know, in an uptrend, that looks fantastic. Downtrend, not so good. Still nice signal there. But regardless, this may be something that's worth exploring. Now, again, before I go off to the signal tester, I've got to then do a little bit of scripting. I've got to be able to codify my rules and then make sure that I've done that right. Now, again, I've mentioned this several times in these webinars. If you want to know more about the scripting and the courses, we've got 3 courses at learn.optuma.com. You can go and take those courses for free, and that'll teach you everything you need to know about scripting. Our goal has been to make scripting as logical as possible. So what I want to do is I first want to put on a show bar. Now this is a nifty little tool which lets us write a script, and then it shows us when those scripts are true. So what I can do here, now this is the way that I like to script. I always like to put things in variables because I like my code to be very neat. So I'm just going to say M1, and you can call it whatever you like. M1's just a habit that I have. So I'm going to say M1 equals MA for moving average, and we're going to make that, I think we had 20, didn't we? I better check our numbers there. So that's 20, and it's just a simple moving average, and I need to put a semicolon at the end of that. That's 100 period, and that one's 20 period. Good. So now we can do M2. M2 equals MA, open and close, and let's just go and set bars there to 100. All right, so I've got my two moving averages here, and now what I can do is I could say, well, when M1, now here's where when you're new to scripting and you're new to this type of analysis, you may think, okay, well, I want to know when moving average 1 is greater than moving average 2. So let's just do that. Greater than M2, and that can be our script here. So we'll hit apply to that, and you can see that there are lots and lots of arrows. The problem is that we haven't identified a signal with that script. We're basically identifying what we would call a condition. And I know it's a bit of a nuance there, but the condition being, okay, moving average 1 is above moving average 2. What we want to know is when moving average 1 crosses moving average 2, because that is the signal that we're after. So let's go and edit our script here, and we're going to say instead of greater than, we're going to, let me just clear that away. There's some really nice functions that we've got here. Crosses above, crosses below, and crosses. Saves us from saying, well, if it was below last period but above this period, then that's my signal. This handles all of that for us. So I can say M1 crosses above M2 and hit apply to that. And let's make our arrows much bigger so we can see them. And so I can look at that now and say, right, now how does that look? Is that a signal that I'm happy with? So the whole point is I want to use this show bar to create these arrows, look at the chart and say, yep, this is probably worth exploring a little bit further. And then what I would do is often I would say, right, let me go and have a look at another, hang on, so I spell apple right, apple there. Let me look at another chart. Not so good in this case, and again, you know, I know from experience this necessarily isn't a great strategy, particularly not on a short term, but you know, we'll continue on with the exercise on this one. Some nice signals there. Looks like it just crossed right in there, went back under again, and then crossed again. So we've got two signals there. But still, I'm looking at this saying, okay, let's keep going with it. It looks like it's worth going. The other thing I need to really note down at this point is, how long do I think this signal is valid for? Because for instance, if it was like a mean reversion type strategy, usually they're only short term. You know, we're not going to be running a 6-month trading position on a mean reversion strategy. But these sorts of trend line, moving average, trend capturing signals, you know, they can hold for a little bit longer. I'm sort of looking here that 6 months seems to be pretty good, July through to April. Yeah, I think a 6-month test on this would be fairly good to do. So we've got that, we've got our strategy. What I'm going to do is I just want to save this script now. So come back in here, I'm going to save script as, I'm going to call it MA crossover. All right, so we've got our MA crossover saved, so I can use that in the signal testing. Now what we can do is jump into the signal testing here. So let's go to the searches and signal tester, and let's create a new item. So you can add groups in here if you want to keep these all organized. Mine's a little bit messy, I must admit, but I'm going to create one in here, and we're going to call it our MA crossover signal test. All right, so the first thing we need to do is set our script. Now we already saved that, so I can come along here and choose MA crossover and just hit apply to that. The next thing we need to do is we come down here is start setting some of these parameters. The first thing I want to do is I want to set the comparison index. Now, what I use depends on which market I'm looking at. Am I looking at the US equity market? Am I looking at ETFs? Am I looking at Australian stocks, etc.? We can set all of that here. For this exercise, I'm just going to stick with the S&P 500 and use those. So what we can do is we'll go SPX. And let's just choose that from the World Indices group. So I'm setting the comparison index. Now, whenever I'm doing one of these tests, you can leave the comparison index out. You don't need to put it in. I like to have one in there because, in today's market where you could be just as easily going and getting a Vanguard index fund, I want to know that I'm beating the index. Or particularly if you're a portfolio manager and your clients are expecting you to beat the index, you want to be able to test this to make sure that your strategies are in fact giving you alpha over the index. All right, so we're going to test on a single code. No, this time we're going to do multiple codes. Single codes are really good if you are doing maybe one of the GAN type strategies. You can do the single code and work on some things there. But in this type of case, being more quantitative, I want to do multiple codes here. Codes to test, already set to S&P 500. I can grab any of my lists. I can grab workbooks and use the tickers in there. I can use the symbol lists that we have, so Bloomberg indexes or portfolios, etc. And of course, I've got my favorites there, which SP 500 set. Now the date range. Now this one's really interesting because we've got to choose a period of time over which we want to test. The goal that I have when I am setting a date range is that I actually want to find a period in the market where the market's actually flat. And that way, when I run my tests, I've taken trend out of the picture. I don't want to have a period of time where there's been a 5% rise in the S&P from start to end, and then I have to worry about taking that out and everything like that. So the easy way to do it, let me just close this. I'm just going to open up the SPX again, World Indices. So what we try and do is we look at this and say, okay, I want a period about 10 years. I want to know that it is a period where the ending price is the same as the start. So of course I can come here with the crosshair and say, well, look, this is a pretty good period. So from September 2000, let me just, if I hold the Alt key down, little tip here for you. If you hold the Alt key down and click, it'll drop a horizontal line. Control Alt will drop a vertical line. So I can come here and say, right, we've got a start date of, let's just say this one here, 28th of August 2000. And if we come across in time, we want to go through both those periods there, just drag across, zoom in here, and we've got an end of the 1st of February 2013. I'm just going to write those down, 28th of August 01 to the 1st of February 13. The beauty is by using that period, as I said, I don't have to worry about trend. So long as I've got gain, then I know that I've been able to get lift over the index, and I don't have to try and do any fancy calculations to get rid of that. And when we look at that, what I love about this, we've got two very obvious bear markets, two bull markets there. Obviously this one had a bit more to go, but as again, it's giving me a really good period to test over. Because we want to be real. If I had said in my test, okay, I just want to test over the last 5 years, totally ignored the fact, a comparison index, then I would have this really nice run up from 2009 till now, but that wouldn't be realistic. We want to be as realistic as possible as we put these strategies together so that we've got confidence going forward. I actually much prefer to be pessimistic and to really try and pare back, the winners and really focus on, let me make sure this is as robust as possible so that if I'm going to market with it, then I've got a really good probability of doing very well. All right, so let's come back to our signal tester and we're going to put in our dates. I'm going to change this here to date range and let's come in here. So we said that it was the 28th. I've got Australian format years, so sorry about that for everyone in the States. And we said 1st of February 2013. All right, so we've got our period there. We're setting our time frame for daily data. So using daily data on this one and keep going. Grouping, we'll cover grouping next week. It's a more advanced feature. Averaging style, median or mean. I actually like to use median. Now, when we get a lot of results like this, we quite often, the way I like to picture it is all the results lined up. Here is our first result at 1%, then 1.2% return, 1.3% return, and keep going, as we get results coming in. When you've got an outlier, there's sometimes where you're going to pick up a trade and it's going to go gangbusters, 2,000–3,000% return in a couple of days. That's the lotto trade. Don't you love it when you talk to those people who tell you, yeah, I'm a share trader. I bought Tesla and then sold it for a 4,000% return and I've retired to an island now. Those stories do happen, but I always call them the lotto trades. You can be extremely lucky and that's fantastic, good on them, but that's not what we can build a strategy around. If we have got these massive outliers which are skewing up our mean. Remember that when we talk about mean, mode, and median from school, if our mean is if we have outliers, it's going to push our mean up. I much prefer to look at the median and say, well, where is the middle of the line? When you line all of these up, what is that return? Both numbers are significant, and they both tell you a different story. For instance, we were just looking at a strategy this morning which had a mean of 25% and a median of -0.5% return. That is huge. That discrepancy, it's actually rare. I've never actually seen that one until this morning. But what it tells us is that, gee, if we can do some work in filtering out some of the losses there, this strategy actually may be really, really good. And so we're going to do some more tuning and things like that. But it's important to understand that difference between median and mode. As I said, I like to use median, which is why we're choosing it here. Periods before, stratification, again, an advanced concept. I'll come back to that one probably next week, looking at the time here. Periods before, periods after. What I like to do here, remember how I said you need to pay attention to how long do you think your signal is going to be valid for? If I was doing mean reversion, I'd be looking at maybe 10 to 21 days. 21 days gives me roughly a month. And so, I'd work towards that time frame. In this one with these moving averages, like I said, it was about 6 months. So what I may do is come along here and say, right, well, let's make that 125. It's roughly 6 months of trading days. And let's just go 21 days beforehand. So I've got 1 month before and I've got 6 months after. So again, just to explain this, the signal that I'm looking at, I want to take every single signal that exists in my data set. I want to find every time I got one of those bars, one of those arrows, and I want to measure what were the returns before that and what are the returns 6 months after. And then I do that for every single instance and average it all up. And that's how the signal tester works. So that's what I'm doing here, is setting those parameters. Draw style, let's just get rid of these for the time being. We're going to auto scale. All of that we can talk about later after we do the test. So now all I need to do is hit test signal, and Optuma will go and do it. This process, which is working right now, it used to be, I was talking to a quantitative analyst who said that he would take 10 hours to do what you've just seen done in 8.5 seconds. Essentially you would have to gather all the data together, find the signal, execute the signal, find all those instances, bring all of those together, line them all up, then calculate the averages, the unmanaged returns moving forward. And it is a long, long process. And so you've seen how quick and easy it is, and how quickly we can just go from idea to idea, test them, and see how it all works. So what I'm looking at here, let's go over this main plot. So in the middle here, we have got what was the market doing leading up to our signal. And as you would expect, we're talking about a fast moving average crossing a slow moving average. I would expect to see this lift going up into our signal. But obviously what we're most interested in is what happens afterwards. So afterwards, we've got 3 lines here. The green line is our signal. And so, we can see here where this signal's up to. The yellow line is our benchmark. In this case, it's the SPX. And then the red line is our alpha. So if you're working on a relative basis, just throwing my pen around, if you're working on a relative basis, then the red line is probably more important to you than necessarily the green line. But we can look at that and calculate that. So we're looking at this over 6 months. So over 6 months time, using this strategy, couple of numbers here which we really need to look at. So this number here, it's telling me that from the period of 2001 to 2013, we got 8,500 results. So this plot here is the average of 8,500 trades. Now when you count that over 12 years, let's just say 250 trades per year. So we're talking about 3,000. That's about 3 or 4 trades a day, or 2 to 3 trades a day that are being generated. And so we're looking at those results. Now, as I've said, if you've read my blog on lies, damn lies, and average returns, you know that an average is not everything. There is so much information sitting behind an average. So when we look at this, the next important plot that I want to look at is the green profit analysis here at the bottom. Now, this chart here, it's so important because this is actually telling me what is actually made up by the average. What are the numbers that were all added together to create that average? So what we do is for every return we get from all of those individual trades, we put them in buckets, 0.5% buckets. So from 0 to 0.5%, 0.5% to 1%, 1 to 1.5%, and so on. And then we just say, we look at all the returns that come in, and we say, okay, well, if there was one at 0.3% return, well, it's going to go in the 0 to 0.5% bucket. And so it gets added in. And then all of those get counted up. And that's what generates this plot here in the profit analysis. And so there's a couple of things that I'm looking for. I want to know that the peak of my plot, which you can see right here at 6%, is positive. I want to know that it's skewed to the positive side, because that tells me that I've got a pretty good strategy here. Then the next things I'm looking for is this dark zone. So here, this line in the middle is our break-even line, or 0% return. And this is our 80th percentile and our 20th percentile. So again, like I said, we've stacked all of these up, we've lined all these returns up, we're counting the volume of our trades. And if there was 1,000 trades, then I want to know if I start at 0 and go all the way along to 800 or the 80th percentile, then what is my return at that point? Do the same up to 20th percent. what is my return at that point? So the 80-20 range is a really nice range of saying, you know, there's a high probability that when I go to market and I take this strategy to market, that I'm going to fall in my 80-20. You know, it's not quite the 2 standard deviations that we talk about. It's a little bit less than 2 standard deviations, but it's still a really nice measure. So we could increase that to 2 standard deviations or something like that, but we just feel that this is a much better representation. Now, the other thing we can do with that is then start using those numbers as a risk and reward metric. So let's just continue on with this. We can look here that we've had a few trades make a complete and utter loss, lost everything out at 100%, and we've had a few that have made more than 100%. Now, if we look at the statistics here, probably again, one of the most important numbers that I'll always go to is what is my probability of gain? Sometimes even more so than the actual mean return and the median return. I want to know that when I go in with a strategy that I'm actually winning more times than losing. Because again, I can handle to have a few losses, but I much prefer to have winners. And even if those winners are small, much better to have winners and know that the strategy that I'm using has a high probability of winners there. So we go in here and we can look there, 62% probability of gain. That's actually really good. And, in actual fact, you would expect that because we're talking about a trend capturing strategy here. When you're talking about mean reversion, your probability of gain's a little bit lower. And so you've got to factor this into the time frame as well. We're dealing with this over 6 months, and you've got to look at this and say, gee, a 5.5% return over 6 months, leaving my money in those positions for a long time. So it all factors in to how you build these strategies. But let's quickly go down. Probability of loss is as you would expect. Mean return, median return, not seeing too much of a discrepancy there, a little bit. So it is telling me, by the mean being greater than the median, that there are some really big winners out there which are skewing this to the upside. Now, when I'm trading, that's fantastic. I want them, I want to let them run, I want to take everything I can. But when I'm testing, I want to be careful about some of those as well. 80th percentile, 20th percentile, so we're talking 21 to 10%. Now that's roughly 2 to 1 reward to risk ratio. So that's really good. Just look out in a future version, we're going to add that metric in here to make that a little bit easier, because it's such a nice way of measuring our potential reward to our risk. Skewness talks about the shape of the, how far the center of this plot is skewed from the break-even line. So it works a little bit in reverse, but the skewness here, by being positive, means that the bulk of our results are in the positive territory. And so that's a really good thing. Remember from high school statistics that you have the standard Gaussian curve. Skewness and kurtosis both talk about how close our plot here is to one of those curves. Kurtosis there, huge number. We have some automatic scaling going on. This is nowhere near a standard plot. We really want to research some better ways to describe how these fit, but for the moment that's in the signal tester, and that's what it means. Standard deviation, of course, whenever you've got an average, when you consider every single signal that made up that average, you are looking at the variance, how far it varied off that average, and then we take the square root of that to get our standard deviation. And so variance is usually the distance squared, and then we square root back to take sine out of it and to get a standard deviation. And a 31%, I mean, that's fairly big again, but these are things that we need to know as we're going through and putting these sorts of strategies together. We've probably gone long enough for this first session, so what I want to do is just stop this session here. We're going to continue on with the signal tester next week. If you've got questions about signal testing, if you've got questions, please don't hesitate to let us know. Do look at the Optuma blog because we've got a lot of articles that go into detail about all of this and can explain a lot of that information that I'm just glossing over pretty fast. Next week we're going to continue on. We're going to look at Monte Carlo. We're going to look at ways that we can look at different periods in the market and how our strategy held up. And we'll even do a little bit of tuning with a couple of different strategies as well, just to get a better idea. Thanks so much for tuning in, and I do hope this has been a real benefit. Thank you.